Hey traders, this is Blake Morrow with Trader Summit, and with me is Jim Welsh from Macro Tides. It is Friday, and we're getting caught up with Jim. I kind of like that title, Catching Up with Jim. How you doing, Jim Welsh?
It sounds catchy.
It does. It is catchy. You know what? What's catchy is not the stock market today. We just came off of a really hot inflation print. We had an ECB meeting yesterday. As you know, I know we're filming on a Friday. You might be watching this over the weekend, maybe Monday or Tuesday, but we had an ECB meeting. The euros just getting smoked, dollar strong. Gold's actually ripping. There's a lot of moving parts right now, and I need some explanation. So can we start with?
Well, you come to the right place, man.
All right, good. I'm glad I did. Let me just let's take a look at the S&P. So, what do you make of this move? Following the inflation data, didn't we all know that it was going to be a hot print?
Yeah, but there's an awful lot of people who were hoping for at least some kind of a downtick, Blake, because there's been this growing hope that, gee, if the Fed gets any better news on inflation, then it will only do 25 basis points in September.
Yeah.
And the Fed has pushed back against that, as I suspected that they would. And in the June Macro Tides, which I would be happy to send to faithful listeners of Traders Summit, because I went into great detail in the June Macro Tides, Blake, and explaining why we could actually see an uptick in inflation based on the various components and so forth. So I think what's happening here, Blake, is this realization that inflation is a bigger problem. As I've said repeatedly, inflation downticking from 8.5% is way different than downticking from 3.5%. So the Fed, basically inflation is running at 90 miles an hour. And just because it downticks, the car slows to 75, the Fed isn't going to take its foot off the brake.
Yeah.
And I think what we're seeing today is the realization that, holy Moses, they're going to have to do more. They're going to do 50 in September. The actual reality, the Fed doesn't know what it's going to do in September. So the market's just been kind of bouncing around in a rubber room, making these guesses, which I think have kind of set people up for this move. So in terms of the S&P, you can see back in the lows of February, March, big ABC up. And we did the same thing, which was why on May 20th, I sent out a special report saying, I think the market's ready to rally to 4150 to 4200 because I thought we were going to get a C-wave rally, or maybe even something better than that, but at a minimum. I think there's a real risk that this thing could just really unravel pretty quickly, because even before the Fed or the CPI print, Blake, I thought the Fed would be pretty hawkish, reaffirming their fight against inflation and so forth, wanting to see convincing evidence that inflation is receding. Is there a chance they could go 75 next week? Maybe. The Fed really likes to, do forward guidance. They don't have the opportunity. But I think, again, it's the realization for market participants that the Fed, getting inflation down from 8.5 is a lot more difficult than trying to get it down from 3.5.
All right. And that's
the chance.
Those are some good points, Jim.
Yep.
So, I mean, if you see us unraveling, where would that take you? Because I can't see it in this count that you have.
Yeah. Well, what it implies is that I think, obviously below 38.10. I think there's an ultimate outside chance for 3,400. We just, it's kind of like the trend is down. Monetary policy is unfriendly. The economy is going to slow. Earnings estimates have still not yet been cut, Blake. And that is the other shoe that I think is going to happen here. Tough talk from the Fed, earnings going down. Why is the market going to rally? And that's been a theme I've been talking about, for a while yet. So I just think that at this point in time, a lot of people are still off sides. And they're just, even though sentiment shows things a lot of people are negative, they haven't necessarily gotten defensive or started to sell in a meaningful way. So this could be a third wave. In other words, you dropped 1,000 points from 4,800 to 3,810 and 1,000 points from the recent high at 4,200. Or even 1,000 points from 4,600. That this could be a third wave where the light goes on for everybody that the old the old thing of holy bleeping hot dogs. So it could get pretty nasty here, because again, here's the reality: most of the people running money today are less than 50 years old.
Yeah,
most of them have no idea what 8.5 inflation means, and what the Fed has to do to kind of corral that. And I just think that a lot of people have just looked back at the last 20 years. Oh, the Fed always caves in. They can't this time around. It's that simple.
Yeah, well, it's a great point. I mean, I've been in the market since the 90s, and I don't know how the market reacts during inflation, high inflation.
Yeah.
I mean, we have not seen this in my lifetime. Well, we have in my lifetime, but not in
in terms of an adult,
right?
Yeah, being involved with markets. Yes.
Right, exactly. So this is definitely uncharted territory for the markets. Now, you also brought up you brought a chart of the Russell. I wanted to pull that chart up really quick. So how do you feel about the Russell 2000 here?
Well, I just wanted to kind of, patting myself a little bit on the back. That May 20 special update that was looking for at least a rally up to 4150, 4200 on the S&P. What I pointed out is that while the S&P dropped below its prior low at 3859, it dropped to 3810. The Russell held above its prior low. So you had a positive divergence, which to me implied that the Russell could lead in any kind of a rebound. So I said buy on May 24th. The S&P, the Russell spent 4 hours under 1750. And then in the weekly technical review this week, the June 6th one, I said sell if the Russell gets above 1903. And fortunately, it did. So again, if the S&P makes new lows, the Russell is going to follow, because monetary policy, weaker economy usually isn't a good friend of small cap stocks.
All right, that's a great point. The next chart that you brought is the German EWG. What do you see here? I mean, this is the German ETF.
Yeah, I mean, yesterday late morning, I'm looking at Europe and I'm seeing how much they were down. EWG yesterday was down over 5%.
Yeah,
in response to what the ECB said. And I looked at that and I said, wow, the S&P was trying to hold 4,074. And I had sent out a note saying, if we took out 4,074 in the cash, the potential for a move above 4,200 would be pretty much eliminated, and then we would go down. And I also had said that if we do get above 4178, that we were looking at a completion of something, and that the next move would be 150 to 200 points down. So when I was looking at this chart at Germany, Blake, it was kind of like, wow, this is some serious stuff. And that to me increased the probability that we were going to see the S&P break down. Obviously Germany looks like it's going to blow through. As you noted before we came on, German Bund rates are just soaring. The spreads between Germany and Italy are really widening. So, there's some potential fractures that are starting to happen. You've talked about in recent weeks, the yen just getting crushed.
Yeah.
Multi-decade lows. So we're seeing stresses, I think, build up, which then reinforces the idea we could be going into a third wave on the S&P to the downside. And that's what I concluded when I looked at the chart of Germany and the other European markets yesterday.
Well, speaking of currencies and the yen, you actually brought us the chart of the euro.
Yes.
I mean, the euro is obviously getting hammered post ECB. But is the dollar, kind of like the shirt I'm wearing? It's the least dirty shirt in my closet. Is that the least? That's why I'm wearing a fall shirt in summer. Correct.
Because a lot of markets are falling. That I had so around. You're perfectly attired.
But is that why the dollar's rallying? I mean, or is this obviously we're euro related this week with the ECB?
Let's back up again, because part of this is educational for traders and so forth. Combining information, fundamental information with technical stuff. And so, weeks ago we talked about, hey, if it gets under 104, it's a good place to buy the euro. And when in May 27th, a couple Fridays ago, when it was trading around 107.50, I was saying, you know what, this is a third wave. You got to take some money off the table because, you know, you're going to get some kind of a correction for wave 4, even if you're then going to go to a higher high. And last week when we were talking, I said, I think the dollar is going to bounce because there's a potential that the currency markets, the euro, is going to be underwhelmed by what the ECB says. So yesterday,
that was it.
Today, what's happening obviously is a reassessment that, wow, the Fed is going to be have to be more different, more stringent, maybe more aggressive, so on and so forth. And that's given the dollar. And that I also sent you a chart of the dollar. But again, the point here is when you get a big, huge move like you saw in the euro over a 2-week window, you just have to take some money off the table because you just don't know what's going to subsequently happen. As it turned out, the pullback much deeper. I was expecting the dollar to rally up towards 103. It did that yesterday. And then my expectation, if we had done this interview yesterday afternoon, it would have been, yeah, then I think we're going to 99.50 before going to higher highs. So instead, the news today, is causing the dollar to, I think, begin what could be wave 5. So it's doing it now as opposed to weeks from now. Because that's one of the things when you and I talk, I said, yeah, I think we're getting a pullback and then we're going higher in a wave 5. We're getting it now on the reassessment of.
So let me ask you this, because with the trading community that I'm in over at Forex Analytics, we talked a lot about today. We talked a lot about the monthly candle of the dollar index. The dollar index actually closed really nasty month on the dollar this last month. Now we're 10 days into this month, so it's very early in the month, but it was a false breakout. It was a multi-year false breakout, bearish reversal candle. So do you put much, and the reason I'm asking you this specifically, because I know you look at technicals, but do you pay attention to candlestick patterns, and do monthly charts really matter to you?
I do not do candlesticks.
Okay.
Monthly charts matter. And what I like to use the phrase layering time frames. So when you look at a monthly chart and you say, wow, that looks really pretty negative, then you have to drop down to weekly and daily charts. And if you really get crazy, you look at intraday information. So you layer time frames to try to manage the risk. So, okay, the monthly just gave a pretty negative signal. But where are we now in terms of ECB, Fed policy, and so forth? So again, I think you always have to break it down to what do I need to be careful of, stay in tune with what's likely to happen in the next 1 to 2 weeks or so. And so, my expectation was the dollar had a pullback, it was going to bounce and then go to a lower low. Well, the reaction yesterday by the ECB news to me was what I was thinking was going to happen. So today's move in the dollar and the euro kind of says, you're going to new highs in all likelihood in the dollar. And ideally, if the dollar can make a higher high and the euro holds above that 103.50 level, that would be, to me, very constructive for the euro. I'd be looking to be almost an aggressive buyer there, because that kind of divergence, where the dollar's making new highs and here's its most heavily weighted component not agreeing, but we're not there yet.
And I think what this tells you, which you pointed out, that if we would have done this video Thursday, your response today would be a little bit different, or it would have been different yesterday. It's important for traders to understand that as data is being thrown at you and the world's being thrown at you, you have to be able to shift gears. You have to be flexible. Look, I was really more of a dollar bear coming into this week. And I got wrong-footed, but that's part of being a trader, right? You assess what's happening, you take your losses, you move on, and you always are taking the best trades based on the information that you're given at that point, and with the best risk-reward ratio, and they're not all going to work out. And that's important that you point that out, that you were able to shift gears just between yesterday and today. So kudos to you, Jim.
Well, there's a lot of big information. And how markets react to that information sometimes is more important than the actual information itself. One last thing before we go, you brought up gold at the very beginning. And I was looking for gold to potentially drop below 1790, 1783, whatever that low was a while ago.
Yeah.
But reversal to the point of the conversation and what you just described, Blake, the action in gold today, like, this is bullish.
It is.
This is bullish, down big reversal. And so my expectation now is I think gold can rally to 1900, 1920.
Wow.
You know, in a quick pop over the next couple of weeks, because again, people are starting to grasp, holy Moses, you know, this inflation problem is really entrenched. One of the things I pointed out in the June macro tides is the April CPI. 76% of the categories, Blake, were up more than 4%. So it isn't just used cars. It's a lot of stuff, or gasoline and oil prices. It's a lot of stuff. And that means it's just a little bit more difficult for that to come down in a meaningful way in a short amount of time, you know? So the catch-22 with the gold is like, okay, how's it going to respond if the Fed talks more, you know, hawkishly, which I believe they're going to. But you know, that's what you got to keep in mind, that you get this pop. A lot of people, I think, were looking for it. As I just said, I thought we're going lower before we got a much better rally. Today's news, I think, changes that. And I think gold has the potential that people are like, wow, look at Bitcoin and the cryptos. They've been dogs. So there was a while where everybody gravitated to crypto and gold was kind of languishing, even as inflation kept ticking higher, higher, higher. Well, here's a case where crypto isn't, you know, as attractive as it once was. Some of that money might actually gravitate toward gold. So this for 1900, 1920.
Okay.
But it's possible it could break above 1920.
So it's going to be interesting to watch. And I'm sure the gold bugs right now that are listening in are loving you, and they're probably hitting the like button on this YouTube video, which every one of you should do. If you like what Jim's doing, make sure you give him a thumbs up on the YouTube video. Make sure you subscribe to our channel so you don't miss any of Jim's content that he does weekly exclusively here at Traders Summit with us. Jim, what's the best way for me to follow you?
macrotides.com. And if you want that June issue of Macro Tides, send an email to jimwelshmacro@gmail. And it's nice. We're getting more people requesting that when I offer this kind of stuff, Blake. So, you know, again, I'm happy to share that information. Part of all this is to educate people, make them and help them become better informed so they aren't surprised by a number like today.
Well, I think a lot of people have been watching you now for months. You and I have been, you know, going on these weekly Friday, conversations for probably closing on, closer to a year. And I think people are really starting to understand that, Jim, you make some great calls and you really understand both the technical perspective of the market, but the macro perspective. So thank you very much for your time. I appreciate it. I appreciate you blessing the Trader Summit community with your presence, and have a great weekend. We'll see you next week.
Thank you for those very kind words. I appreciate it. And you have a wonderful weekend too.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.